Welcome to Trading Nation. I'm Kate Rogers. Stocks hitting all-time highs again, and our next guest has a chart that he says suggests this breakout actually has legs. Jeff Saut is with Raymond James. Welcome, Jeff. Thanks for being here. You say this is the chart that's worth 1,000 words. Tell us what it is and why.
Well, you've basically been in an upside consolidation, just like you were between May of 2015 and February of 2016. And in February of 2016, where Royal Bank of Scotland told people to sell everything but high-quality bonds, the second leg of the secular bull market began. So our models told us to raise some cash in January. It told us to put that money back to work in the second week of February. S&P is up about 15% since then, broken out to new all-time highs, breaking out of a base like we've been in, that upside consolidation phase. Tells me that we're going to be, above 3,000 probably by Thanksgiving and probably 3,100 to 3,200 by the end of the year.
So what's indicating that Thanksgiving target and end of year target? Can you elaborate a little bit more? Because I understand you typically don't make bets like that, but you're feeling really confident right now.
Yeah, my father was a portfolio manager, and he told me if you get it directionally correct, you're ahead of the crowd. So don't give people targets. But earnings, as we've said, we transitioned from an interest rate-driven secular bull market in mid-2015 to an earnings-driven secular bull market. Earnings continue to come in better than expected. Valuations are not that high. There's been a tectonic shift from tangible assets on corporate balance sheets to intangible assets, which you can't really put on balance sheets, but intangible assets by definition should carry higher valuation metrics than historic norms. So we have been bullish since the February 9th undercut low.
So tell us what your favorite sectors are for investors right now in this moment.
I like your previous guest. I like financials. I think that they are in a secular bull market and they remain undervalued here. Because too many people are looking at the yield curve, and I think it's the wrong yield curve. Back in the day, in the 70s, the yield curve you looked at was the 90-day Treasury bill to the 30-day Treasury bond. For some reason, everybody's looking at the 2-year to 10-year Treasury note right here. We think that's wrong. We think that the 90-day T-bill to 30-year Treasury bond yield is nowhere close to inversion, and we continue to think earnings come in better than expected, and people are still fearful.
So I know you're feeling really confident in this market, but what are the biggest risks for investors right now?
I think the biggest risk is geopolitical. But as we've said on this program many times, we think the trade tariff wars go away. We think NAFTA agreements, and it looks like that's come true with Mexico, and we think it's going to come true with Canada. We think China is in a economic slowdown, and that President Trump is pressing them up at the exact right time, and we think China will blink, and we think that'll be very positive for the equity markets.
Okay, Jeff Saut of Raymond James, thank you so much for joining us today, and thank you for watching Trading Nation. I'm Kate Rogers, and we'll see you next time.
Hey traders, did you like that video? There's more where that came from. Scroll down and click on the links to the right of your screen. We publish new videos and commentaries from our experts every day. And don't forget to follow us on Twitter @Trading Nation.